So, you want to own a pawn shop. You have walked past one. Barred windows, a sign that says, cash for gold, guitars on the wall, a glass case of watches. Somebody walks out with cash, and their ring stays behind the counter. You look at that, and you think one thing. That is a lender that never has to sue anyone. And you are right, completely right. If the loan does not get repaid, there is no lawsuit, no collections call, no credit hit. The shop just keeps the ring. That is the whole enforcement mechanism. Not a court, a drawer. But there is a question worth asking before you buy in. What is that interest rate you keep hearing about? 10% a month sounds almost reasonable. Until you do the arithmetic, banks are required to show you. Multiply by 12. That is 120% a year. And in some states, the legal ceiling is 240%. New York caps it near 4% a month. Texas allows up to 20%. The same loan on the same bracelet can cost a customer 6 times more, depending purely on which side of a state line they walked into. Here is the reframe that explains the entire business. A pawn shop is not really a lender. It is a retailer that uses a 30-day loan to buy inventory at 25 to 60 cents on the dollar. The interest is not really the profit. The interest is the price of patience, while roughly 1 loan in 6 quietly becomes a purchase. So, let us build one properly. What it costs to open, what a loan actually pays, and what happens to the item that never comes back. Then the part nobody puts in the storefront. Because right now, in 2026, this industry is having its best year in a generation, and it has almost nothing to do with lending. Start with the ticket price. This is one of the cheaper small businesses you can open, and that is not an accident. Most owners report needing $50,000 to $150,000 to open a single location. Licensing alone runs $1,000 to $5,000, plus a surety bond, often $5,000 to $50,000, protecting customers against misconduct. If you deal in firearms, and most shops do, add a federal firearms license on top. Then, working capital, and this is the part people underfund. You need 6 months of rent and payroll sitting untouched, separate from your lending cash. Miss that, and your first slow month forces you to choose between paying rent and making loans. Neither choice ends well. The inventory and loan cash itself runs $10,000 to $50,000 just to open the doors without an empty showroom. Compare that to a restaurant or a gym or almost any other storefront business. This is startup cheap, licensed like a bank, and enforced like neither. And the licensing itself is unusually invasive for a small business. Background checks, fingerprinting, proof of adequate capitalization, sometimes an annual renewal. Some cities restrict how close you can operate to a school or a church. None of that exists for a coffee shop next door. Now the mechanics of a single transaction, because this is where the misunderstanding lives. A customer brings in a bracelet worth $1,000 at resale. The shop does not lend $1,000. It lends between 25 and 60% of that, so call it $400. The loan term runs 30 to 60 days. Monthly fees, combining interest and storage, typically run 5 to 25% of the loan. At the middle of that range, that $400 loan brings in maybe $60 a month, just sitting in the case. Notice what set that number in the first place. Not the customer's credit, not their income. A pawnbroker's entire underwriting process is a 5-minute appraisal of an object, done by eye at the counter. Get that appraisal wrong in either direction, and the business fails. Overvalue the item, and a defaulted loan loses money on resale. Undervalue it, and a competitor across the street simply offers the customer more. So, the single skill this entire business is built on is not lending, and it is not sales. It is knowing instantly what things are actually worth in a market that changes every single day. Multiply that fee by 12 months, and you get the number people find shocking. But nobody is meant to hold one 30-day loan for a year. That is the point. The item is non-recourse collateral. If the loan is not repaid, the shop keeps the bracelet and sells it. There is no debt left over, and no consequence for the customer beyond losing the item. Which means, from the borrower's side, walking away is not a financial catastrophe. It is a choice, and a fairly common one. There is no repossession truck, no phone call at dinner, no mark on a credit report anywhere. The entire downside of default was priced in and paid for in advance the day the loan was written. Now the invisible machine. And to see it, you have to stop thinking of the interest as the product. Industry data puts national forfeiture, meaning the customer never returns, somewhere around 15% of loans. Roughly 1 loan in 6 converts, on schedule, into merchandise the shop already owns at 25 to 60 cents on the dollar. That is not a bad outcome for the shop. In many months, it is the better one. At a large public chain, merchandise sales now make up close to half of total revenue. Not the loan fees, the resale of the collateral. And gross margin on that resold merchandise runs in the mid-30s to high 30s%, on top of the discount they already paid for it. So the loan was never only a loan. It was also an option to buy the item later, at a price fixed the day it walked in, no matter what happens to the market in between. And right now, in 2026, that option has become extraordinarily valuable because of one commodity. Gold has surged roughly 90% over the past year, trading above $5,000 an ounce. For a pawn shop that does 3 things simultaneously, and all 3 help, it raises how much a shop can safely lend against a gold item, since the collateral itself is now worth more. It raises the profit margin the instant an unredeemed piece gets melted or resold. And it pulls in an entirely new kind of customer, walking in specifically to sell jewelry outright for cash. No loan involved at all. One of the 2 large public pawn chains reported jewelry scrap sales up 288% year over year. Scrap margin near 38%. The other reported quarterly revenue crossing $1 billion for the first time, up 26%. Pawn balances up 19% in the same quarter. Average loan size has climbed from around $160 in 2022 to over $230 today, because the collateral itself is worth more. None of that came from better lending. It came from a bar of metal getting more valuable while it sat in the case. And the shops did not need to predict any of it. They simply held the collateral long enough for the market to move underneath them. Now the risks, and this industry has a specific one that almost no other retail business carries. Every single item that comes across the counter might be stolen, and the shop is legally the last stop before it disappears. In February of last year, federal agents raided a pawn shop in Manhattan's Diamond District. The 2 operators were accused of running a fencing operation for organized burglary crews, buying watches, handbags, and jewelry stolen from wealthy homes across the country. Investigators seized roughly $5 million in suspected stolen property, plus cash, from the shop and a set of storage units in New Jersey. Undercover officers had been selling them goods they explicitly described as stolen, over more than a year before the raid. This past April, both men were sentenced to 46 months in federal prison. The prosecutor's language was blunt. They had tried to make a quick profit and instead bought themselves a lengthy prison sentence. And this was not an isolated case. A separate chain in central Illinois was charged with running an organized retail crime ring, allegedly fencing stolen goods and laundering the proceeds through silver bullion purchases. Read what these cases have in common. In both, the pawn shop was not a victim who got fooled once. It was the market itself, built to move stolen goods at scale. That risk sits on every single transaction, not just the criminal ones. Most states require reporting details of every pawn to police within 24 hours, and holding items for a set period before resale, specifically so stolen property can be identified and recovered. Miss that discipline, even honestly, even once, and you are the one explaining your inventory log to a detective. If this breakdown is useful, subscribe. It genuinely helps. There is a second risk, quieter but constant. This business is a mirror of economic stress, and that cuts in a direction people do not expect. Loan demand rises when people are struggling, which means the best months for a pawn shop often coincide with the worst months for its customers. Same-store pawn balances climbing 19% in a single quarter is not on its own a story about prosperity. It is closer to a real-time gauge of household stress, running slightly ahead of the official economic data. Payday lenders and rent-to-own shops track the same signal. Pawn is simply the oldest version of it, and the only one with collateral sitting in a drawer instead of a promise on paper. All right, numbers. 2 scenarios, same shop, different weeks. Scenario 1, an ordinary month. 200 active loans averaging $300, so $60,000 out on the street. Add a 10% monthly fee, that produces $6,000 in fee income for the month. Roughly 15% forfeit. 30 loans convert to merchandise the shop already paid 25 to 60 cents on the dollar for. Resold at typical pawn shop margins, that merchandise alone can add another $4,000 to $6,000 of gross profit for the month. Add retail buy-sell activity on top. A single small shop can plausibly clear $10,000 to $15,000 of gross profit monthly against a payroll of 2 or 3 employees and 1 rented storefront. That is the ordinary case. Steady, boring, and it works whether or not gold is doing anything unusual. Scenario 2 is this year, specifically, and it shows what happens when the commodity moves. Same shop. Gold-heavy inventory, because gold jewelry is the easiest item to value and the easiest to resell. Loan collateral values rise with the metal, so average loan size climbs and fee income climbs with it. Forfeited jewelry that would have sold for $800 last year now sells for closer to $1,500, without the shop doing anything differently. And walk-in customers selling gold outright, no loan at all, add a stream of margin that barely existed 2 years ago. The exact chains reporting this told their shareholders precisely that. Record revenue, record margins, and the explanation was gold prices, not lending skill. The gap between an ordinary year and a year like this one has nothing to do with how the shop is run. It is sitting in a display case, priced in dollars per ounce, set by a market 12 time zones away. So, who is this business for? It is for someone comfortable being simultaneously a lender, a retailer, and a commodities trader in gold and silver, and the last checkpoint against stolen property, all inside one small storefront. It rewards rigorous paperwork and boring discipline. The 2 operators in the Diamond District did not go to prison for pawnbroking. They went to prison for skipping exactly that discipline, on purpose, for profit. And it is worth being honest about where the money actually sits. Not primarily in the 10% monthly fee, which reads as extraordinary and mostly is not. Remember, it was never meant to compound for a year. The real economics sit in the 15% that never comes back, bought at a deep discount and resold at retail, and in whatever a bar of gold happens to be worth on the day the 30 days run out. The lending is the front of the store. The retailer and the commodities desk were always what was actually being